Welcome to the B.F. Anderson Technical Report for April the 7th. When you stop growing, you start dying. Growth stocks have been underperforming this market for about a year and 3 months. And a lot of the attention is being placed on consumer staples. As we look at the aggression index, you can see that we have turned back down again, which means that the consumer staple stocks are outperforming the NASDAQ, which is growth stocks. And the problem here for me is that we are growth managers because we feel that growth makes a lot of sense. You've got to be coming out with new things on a regular basis as a growth company. So as we see this, the problem comes in, whereas these consumer staples, the only way they're really able to grow revenues or grow their earnings is with inflation. So as a result, you're seeing a lot of attention being placed on the consumer staple stocks. I'm talking about soft drinks, tobacco, pharmaceuticals, toilet paper, stuff that has to be used day to day. But as you can see, the consumer staples are somewhat outperforming. Here's a graph just showing the consumer staples. You can see here what the graph looks like. So the problem here is it kind of tends to be a trap, because back in the 70s, I remember that we had hyperinflation. But if you found a stock like Walmart back in the 70s, which was a growth stock, it was a cookie cutter type growth stock where they're opening stores, and basically, it was a growth stock. So if you were hung up into the consumer staples or the energy stocks or whatever, you would have missed Walmart. Anyway, let's take a look at what's going on. Market has been selling off. We've got the NASDAQ pulling back down again, breaking below that base, barely holding that 50-day moving average. So we're continuing to see weakness in the NASDAQ. Again, the 35-week moving average, we've come down. We never got back above that 35-week, and also the 35-week continues to be in a downtrend. Then if we look at the mid caps, you can see the same problem. We're breaking down below that base, breaking down below the 50-day moving average, never really held above the 200-day. New York Composite, all the stocks on the New York Stock Exchange, somewhat breaking down as well. These are somewhat failed breakouts. In other words, we broke out, failed, and it's just the way the market is right now. This is small cap stocks. They're really somewhat pulling right back down into that base, trying to probably make a new low. Here's the S&P 500. Again, same problem. We broke out above the 200. Now we're back below the 200, somewhat of a failed breakout. Here's the 35-week. We got above it for 2 weeks and then didn't hold, and we're pulling back again. Now, this is our new indicator we're looking at. This is where we're comparing the S&P 500 to the 30-year Treasury bond. Somewhat good news here. Stocks are continuing to outperform bonds because interest rates are rising. You can see here, though, that the S&P itself is not making a new high. However, the ratio is making a new high, which is a positive. Here's our three economic indicators. You can see interest rates really, in a very strong uptrend. Oil continues to be volatile. We got up as high as over 120 a barrel. Now we're back down below 100 a barrel. Financial stocks, however, are not outperforming. You would think with interest rates moving up that wouldn't be the case. New lows. We're starting to see again a level that is getting too high. We like to see new lows get below 40 a day, and just recently was 116. Sentiment continues to be, back and forth. This will be updated today, but as you can see here, sentiment has, gotten more optimistic, but still considered to be in the fear camp, below the average. Here is the the trend strength. On the NASDAQ, last week we got up to 50%. Now we pulled back to 25%. On the S&P 500, we got to 100%. Now we pulled back to 50%. So you can see that this rally is continuing to struggle. Volatility index, the VIX did somewhat improve. Now, we dropped all the way from up around above 30 to below 20. That has been quite a rally for the VIX, so it's now turning back up again. Here's interest rates. This is the TLT, which is the 20-year Treasury bond. Look at this. I mean, this thing is really pulling back. And what I really think is interesting is as I started studying these inflation-protected security stocks or funds that invest in TIPS, which are inflation-protected bonds, they too, even though they're inflation protected, these bonds are having a tough time. This is the Schwab inflation protected fund. You just really have to ask the question, if this is inflation protection, which was, you can see here where the market was worried about inflation, is the market really not that worried about inflation? Well, we'll just have to see. Now here's some of the top 5. Again, these are just stocks that we're seeing strength in. This is Sierra Oncology, which is biotechnology. Here we have Occidental Petroleum. Again, the energy stocks have continued to hold up, not really breaking out and making any progress, but continue to be one of the stronger sectors of the market. Here's another medical supply company called Lantheus. You can see here gap up, in an uptrend, is holding that 10-day moving average. Here we have CF Industries, which is fertilizers. Again, this is one of those inflation plays. Again, consolidating in here, had kind of a big sell-off, but then came right back into form a new base. Here we have Alpha Metallurgical Resources, which is coal. You can see even the coal stocks, just like the energy stocks, are just continuing to consolidate and not having a lot of trouble, but they're really not doing exceptionally well. So if you have any questions, let me know. Thank you very much.